Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to another episode of Behind the Advice. The topic for today's episode is investing in shares as an Australian expat. And it's quite a topical subject at the moment, particularly with how markets are looking at the moment. And I'm lucky to be joined by my friends, Adam Bolton from Bolton Financial Services today, a financial advisor. How are you, Adam?
Yeah, great. Thanks, Mitch. Thanks for having me.
Pleasure. And a bit of a fun fact. So when I first started out in financial planning, my first role in financial planning was a support officer, where Adam was the financial advisor. So definitely learned a lot from Adam. So it's great to have you on the podcast today.
Yeah, thanks, mate. I just do remember those days, and even then you showed a lot of potential and a bright future in this space. Thank you,
mate. I appreciate that. So, just starting off on a personal standpoint, what kind of got you into financial planning?
I kind of fell into it. Sort of wasn't the initial plan. Went to university. I think like everyone thought was going to go into investment banking and then into stockbroking. And well, I was at university, did some work placement at a stockbroking firm, and one of the very senior partners there took me aside one day and had lunch and talked about a few things, and talked about how that he saw that the way the industry was moving was that holistic advice was the future, and individual portfolio management maybe wasn't the value proposition that it had been in the 80s, 90s, 2000s, and that sort of led me on the path then to follow that that journey.
Yeah, very interesting. And I think the industry over the last 10 years has definitely moved in a much better direction. I think financial planning and advisory was very much synonymous with investing and stockbroking, where it's kind of moved into much more of a profession over the last 10 to 15 years. And it's a great direction to see the industry go into. What do you like about financial planning more broadly?
The first thing is what attracted me to being an advisor is the ability to help people. And everybody's circumstances are different. Even if on paper people think, nothing special about my situation, or my situation's fairly, straightforward, it's always slightly different from the next person. There's never two people that are the same. And what's really important in terms of what we do and the value add that we should, advisors should be bringing to clients is treating everyone as an individual and everyone's situation uniquely, because everyone is unique.
Absolutely, mate. Definitely not a cookie cutter approach in financial planning. And, it's kind of a nice segue into my next question. When, we think about financial planning and we think about investing in shares, not anyone can, provide advice on shares. So, when we think about providing advice, financial advisors, we need to be licensed, don't we, to provide advice?
Yeah, correct. We need to be licensed to provide advice, but even within our licenses and our agreements there, we have areas that we're allowed to provide advice in. We have to demonstrate to our licensees or to external third-party compliance managers, if you're self-licensed, that you have the adequate qualifications, background, and ongoing education requirements have been upkept to provide advice in the areas that you want to provide advice. So, direct equities, shares, etc., is an area that a lot of licensees are very, very strict on in terms of if you don't have a significant background, education, and ongoing education in that space, they won't allow you to provide advice on shares, equities, or market-listed products.
Yeah, it's very stringent, for good reason. And I think it's good for Australian expats to know, if you are working with an Australian financial planner, how we are licensed and how, stringent the regulation that governs financial advice on things like shares is. Let's get into investing in shares. Now, this is going to be, we're kind of just going to get into the basics of investing in shares. We're not going to get too technical in today's discussion. And then I'll kind of put it into the context of investing in shares as an Australian expat as well. But first and foremost, like if we think about, let's get into the basics of investing in shares. So I think, Adam, how would you kind of describe just the concept of investing in shares? Like what is share investing and what is a share?
Yeah, so shares are ownership stakes in a publicly listed company or publicly listed entity. That's the simple version of that, with the view of when we invest in those, it's because we're looking for either capital growth, so an increase in value in our shares and an increase in value in that company, to keep it simple, or we're looking for some income to be paid for our loyalty in investing those companies, which is in the way of dividends or distributions or interest payments or things like that. And then, we then build portfolios from that to then help people achieve, whatever their goals are. And everyone's goals are different as well. So different types of shares in different companies fit different investors in different ways.
Yeah, absolutely. And, I think the general, to understand a share, you're buying into a company. And obviously the goal of most companies is to make a profit and, be profitable. And by being a shareholder, you can enjoy that and you can participate in that business's growth and the income that comes from being a shareholder in that company. Now, I think let's get into the major benefits of investing in shares. So we touched on, capital growth, dividends. From a wealth accumulation standpoint, what would you say is some of the main benefits of investing in shares?
Yeah, so historically, the average long-term return on shares, when you look at we'll talk about major index markets or developed markets, the long-term average return on share markets is quite attractive for people. It doesn't come without risks, like any investing. There's a risk and return trade-off there. But then in terms of that, then it provides also an easy method to diversify your portfolio, which is really, really important when we talk about wealth creation and investment, is making sure that we don't, I guess to use the analogy, put all our eggs in one basket. And investing in shares gives us the ability to spread those our investment funds across a number of different assets, sectors, companies, etc., to help try and diversify a little bit, while overall picture of trying to achieve whatever our wealth goal might be, whether that's capital growth, income generation, combination of the two.
Yeah, and that's a really good summary in terms of the benefits of investing in shares. And as you mentioned, when it comes to investing in shares, diversification is key, right? We don't want to, as you said, Adam, don't want to put all of our eggs in one basket, taking a diversified approach against within different sectors, different asset classes as well within a portfolio. But I think, diversification is key. We're not looking to just, go all in on one particular stock. And I think us as financial advisors, that's the sort of guidance that we provide when it comes to share investing for our clients. We look to build well-diversified portfolios. Generally, we're not looking to do anything speculative when it comes to those underlying investments. It's usually blue chip type companies that we're incorporating into these portfolios for clients. And the idea is to have that long-term view when we are investing. Shares are not a short-term investment. And I think the concept of just being invested for the long term is difficult, for most people to get used to, particularly if it's your first time investing. Like long term is 3, 5, 7+ years, and that's kind of the minimum time horizon we're looking at when we're investing in a portfolio of shares, because there will be troughs, there will be ups and downs. So before we even think about investing in shares, we always want to be looking at our long term investment time horizon.
Yeah, I think there's two really important risk factors that we usually spend a lot of time in educating prospective clients or clients about when it comes to investing in shares. Is the timeline risk is a really important one, and that is with the funds that you're investing, when do you potentially need those funds, if at all? And if it's I just want to park it for 12 months because I'm looking to buy a house or to do whatever, well, then we have to have a very robust discussion about the risk-return trade-off and hey, if your portfolio is to drop 25% in these next 12 months, it doesn't give you a lot of time for that to recover. So then what does that mean to you in the real world? Well, what that means is whatever you plan to use those funds for, buying a house or an investment property or whatever it might be, is significantly reduced, and that carries significant risk to the client. So it's a really, really important discussion there. And the second one as well, which is not talked about, I think, enough, is liquidity risk as well. And that is, making sure that what people potentially need money for, or the just-in-case scenarios, or the emergency scenarios, if we have adequate emergency savings and other strategies in place, okay, that helps mitigate some of that. But realistically, you need to look at, when we look at portfolios, we look at that liquidity risk of, if shit goes wrong and we need to liquidate part of the portfolio quickly to meet medical expenses or to meet something like that, how liquid is the portfolio? And that's why using shares or market-listed products can be beneficial, is because the liquidity timeline, because they're actively traded on the market for the majority of investments, not all, but the majority of them, it's quite easy for us to realise those funds within sort of a 5 to 7 working day scenario versus, if you've got like a 12-month term deposit, you can break that, but it takes some time and it costs you money to do so. So that's another important factor that we have discussions with clients about in terms of that, along with the timeline of investment. They're two really key conversations to have when starting the investment journey.
Yeah, definitely. And liquidity is a huge benefit. And it's if you contrast it to other assets, you don't really get that same benefit of liquidity with property, for example, if we're contrasting the two asset classes, and something that shares definitely have working for them. And yeah, so long as the share market's open, generally you can place the stock, you can sell the stock, and have the proceeds kind of in your bank account in 2 to 3 trading days. So we touched on a lot of the benefits of investing in shares. Let's just kind of highlight some of the risks. So the risks and disadvantages of investing in shares. What would you say is maybe the top two?
The fact that they're dynamically priced. So the investments are priced every day, and you can log into your portfolio or go onto the share market, any number of websites, and look up the price of your asset. And
which is a double-edged sword sometimes, right?
Absolutely. And they do move day to day, minute to minute, second to second. There is variations there, and some of those are for reasons we can identify, whether it's specific to the company involved or specific to the sector or the market they're in, or sometimes it's just as simple as more sellers than buyers or more buyers than sellers. Like there's no real good reason for it. And sometimes it's about being able to be patient with that and understanding that. But then also I think goes with that is that volatility. Yeah, that volatility, you can have things, I guess, come out of the blue that then can cause those even blue chip companies that are doing quite well to have a decent pullback. So a really good example was a few years back now. Woolworths went through it, to say the least. They had, I think it was a change of CEO. Coles at that time were everywhere. They were killing it with their sponsorship of MasterChef. Their market share had grown. Woolworths had shrunk a little bit. There was some pressure from Metcash at the time, or IGA, and there was also some scaremongering or some concerns around the impact of Aldi. So the Woolworths share price got absolutely pummeled. I think it went from $30, maybe $34 down to about $19, maybe $17 it got down to. Again, really, really good blue chip company, but for a number of factors, sector-based, market, penetration-based, and also management uncertainty, cause that to happen. And those things can come out of nowhere and not things that you can control even as an advisor or as an investor. You don't have a lot of say over that versus money in your bank account. Well, you have a fair bit of say over that. Yeah,
definitely. I think certainly the daily pricing of your portfolio and the stocks in your portfolio can be a little bit, it can be hard to manage, particularly for first-time investors or new investors. And I generally say with clients that, have just signed on and just, started investing and we're working together as part of an ongoing financial strategy, don't check your portfolio every day. Don't even check it every week. I mean, it's your investments at the end of the day. It's your prerogative to check it when you like. But if you want to be a better investor and if you want to be able to manage the ups and downs of your portfolio in a much more efficient way. Don't be checking it that frequently. I kind of encourage clients to look at their portfolio if they like on a monthly basis, and then we have quarterly performance reports that go out to clients, because if you're checking it intraday, every day, it's going to be up and down. You're going to drive yourself crazy, to be honest. So taking that long-term view and being patient with your investments over 3, 5, 7+ years is the best recipe for success, and it's going to make you a better investor at the end of the day. Because ultimately, the more time you spend in the market, the more time you have to go through the ups and downs of the market, the less reactive you're going to be when you see market pullbacks in the future. So I think it's time in the market, and understanding that you need to take that long-term view with our shares.
Yeah, absolutely, Mitch. It's a really good point about the time in the market, and we've seen historically over time, and let's look back at a number of market, let's call them crashes, events where we've seen, COVID, and we saw GFC, and we've seen dot-com bubble and Asian debt crisis, and plenty of those events over the last 30 years or thereabouts. They do happen. It's inevitable. But we also then, when we observe the overall trend over that time, the market finds a way and continues to find a way over time, and the recovery of those events are not linear. So COVID bounced back much faster than expected, and probably a little bit too fast in my opinion, but that's just my view. But then some other events like post-GFC, that took quite some time, but still recovered, grew past that point, and then by the time the COVID scenario hit, we were most market indexes were a long way ahead of where they were pre-GFC. So you're right, the time in the market to be able to tolerate that, the robust discussions around the time in the market and around people's risk tolerance. It's all well and good to want to have great returns and have all the upside benefit, but if you're not willing to sit through those times of market volatility and corrections with the view of, hey, this is, we've got to go through this in order on average to get the greater long-term benefits. If you're not willing to do that, then there's discussions that need to be had about how we diversify or reduce some of the risk exposure in your portfolio. But in terms of if we're reducing overall risk, then generally the discussion then becomes, well, we need to temper our expectations on overall returns. So it's an excellent point you make about the willingness to be able to be patient and have confidence in the long-term big picture, and having comfort in your own risk tolerance and your own investment timeline.
Absolutely. And I think the markets, investors, we're inherently optimistic. You have to be optimistic about the market to be a successful investor. You have to have the view that companies will be profitable in the long term. Economies will, they'll go through their rough patches, but ultimately they will perform, and they will, prosper in the long term. And that's kind of the view that us as financial advisors have when we're recommending shares to our clients. Now, we talked a lot about shares, and I think shares is a relatively straightforward concept when we're looking at different investment products and investment options that are in the market. And I wanted to get your thoughts on exchange traded funds, or ETFs. Now, these particular types of investments have been in the market for over 30 years now, but I think they really rose to popularity, particularly during COVID, like during early 2020. I mean, they were popular before that, but certainly mass adoption was taken up in the early years of the pandemic. So, Adam, what is an exchange traded fund?
Yeah, okay. So an exchange-traded fund is a market-listed investment option. It's kind of like a managed fund, or for US listeners, a mutual fund, except it is listed on the stock exchange. So therefore, you've got easy liquidity. There are certain requirements on the ETF provider. So they're your traditional fund managers. There's plenty of them out there by, like BlackRock, Vanguard, and plenty of smaller players as well, or very niche players. And what they do is they provide you the ability to invest in an asset class or an index or a sector that are very specific to what that fund is. Now, some of them are quite general, and they are things like the ASX 200 index, for example, which is an exposure to the top 200 stocks in the Australian stock market. Some are a little bit more specific than that. So, for example, it might be like a NASDAQ 100, which gives you exposure to the top 100 tech stocks in the US. And then you can find some that are really, really quite niche. Things like, uranium, or in cybersecurity, or esports one that's
different themes, right?
Yeah, exactly right. So it gives you the ability to invest in a basket of shares behind the scenes that the fund manager picks and weights and does based on their own investment mandate. And you're not trying to, or as advisors, we're not trying to share pick and try and, I use this term, we're not trying to do Wolf of Wall Street sort of stuff and try and pick all winners or whatever else. It's more about finding those sector or the appropriate, exchange traded funds that may complement somebody's portfolio based on either the liquidity needs, market exposure preferences, or in some scenarios it might be very sector-based interests that they may have, where we want to give some additional exposure there outside of our usual methods or usual index funds.
Yeah, that's a really great summary in terms of what a ETF is. And I think the main key benefit is diversification. We can really place one trade, and through that one trade into an ETF, we're gaining access to a basket of underlying investments. Generally, they're going to be shares, but they can be used for many other different asset classes as well, bonds, property investments as well. We won't get into those today, but I think the key takeaway there is diversification benefits, and they're also pretty low cost at the moment as well. I think fund managers are just getting more. When I say fund managers, these are the businesses that create these ETFs and make them available to investors. They're getting very competitive, and they're constantly looking to reduce their fees to be more competitive. So they're also a very good low cost investment option, and you only need a relatively small investment to get started in investing in an ETF. And you mentioned managed funds as well, Adam. Managed funds were the first managed funds were kind of popular before ETFs. They obviously don't have the same level of liquidity, I would argue. Generally, some managed funds, the key difference between a managed fund and an ETF is a managed fund is not listed on the stock exchange. So you can't just sell it when the market is open and, redeem your units in the managed fund as quick as a ETF. But they have a similar, they work similar to ETFs in that you can buy units in a managed fund, and then again, it gives you access to an underlying basket of investments in that fund. Adam, you mentioned before, a couple of different indexes. So, NASDAQ 100, ASX 200. For the listeners, do you want to just give a quick summary in terms of what a market index is and what they're used for?
Yeah, so a market index is a benchmark essentially of a particular sector or a particular market. If we don't like using the double usage of the word there, but and what it does is measured against the weighting of that particular sector. So, for example, if we use ASX 200, because that's the easy,
it's a good example. Yeah.
So that's an ASX 200 index fund gives you exposure to across the top 200 listed companies on the Australian Stock Exchange, and within that index, they're all weighted slightly different based on the size of the company versus the market overall and that particular sector. So, for example, within the ASX 200, you're going to see like big four banks are going to feature quite prominently in there because as part of our overall stock market, they are the bigger holdings. So it's not an equal weighting necessarily. It is market weighted based on the size of they are on the index. And then, that gives you, so then as those markets rise and fall and as the performance of that over time moves, we expect those index funds to move relatively in line with that, and there shouldn't be too many surprises there. If the ASX 200's had a rough run, we certainly expect those funds not to have done so well. Mm-hmm. And if the ASX 200's had a great run, we expect that to follow fairly closely. And within that, we don't have to guess and pick and choose which of the ASX 200, or in the case of, if we're starting out with a portfolio and we're trying to diversify, and so the pieces of the pie are sort of getting cut up and a little bit smaller than what we're allocating, being able to invest in an index fund or ETF index exposure gives us the ability to buy smaller chunks of that versus if we're trying to buy all 200 stocks on the ASX 200 individually, we're buying like 1 and 2 shares of some of these companies, or some of them might even be we realistically, to keep it weighted, we need to buy 0.4 of a share. Well, in Australia, we don't have the ability to do that.
Yeah, exactly. And I think, they're a good way to just keep tabs on what the market's doing. And if you've got a portfolio of shares, a portfolio of shares, Australian shares, international shares, whatever that might look like, they're a good way just to, as I said, get a health check on, or just check up on what the markets are doing. And I generally encourage clients, instead of looking at your portfolio from time to time, just keep a look at what the share indexes are doing. So if the ASX 200 is down, if the S&P, so the US S&P 500, which is the top 500 companies by market capitalization listed in the US, if that index is down, there's a fair chance that your portfolio is going to be down as well. And that way you're kind of just looking at the general direction of the market rather than seeing your portfolio in dollar value kind of go up and down. It can kind of help with maybe some of the stresses of just seeing, the value of your portfolio fluctuate on a monthly or quarterly basis, however often you're checking it.
Yeah, and I think that's something that we probably could have talked about before in terms of the benefit around shares or market listed assets is in the ability to build portfolios utilising either shares or, say, exchange traded funds with index exposures and stuff like that. If we're thinking about just a general portfolio construction where we're trying to diversify and create, long-term growth and some income generation, let's use that as the example. Well, then utilising some of these like exchange traded funds that are index linked, it gives you the ability to, like you said, you can see on the news what these things are doing. You can get a bit of a feel what the portfolio is doing without having looked at it, on your reporting or on your portfolio, platform. And it also gives you better transparency into your portfolio as opposed to having a single line item or maybe 2 line items that you're sort of like, that sounds like a great name, but I don't really know where that's invested. Well, where shares and market listed assets give you that, one of their benefits is it gives you transparency on how your portfolio is invested, so you have more peace of mind about where your funds are sitting. So when you see the news of a night or in the morning or whatever else, and you see the ASX 200's up or down X amount, or the S&P 500's up and down X amount, or the Dow Jones or the FTSE or whatever has moved, and you're like, oh yeah, hey, I've got that ETF in my portfolio. You're keeping up with it without actively keeping up with it, if that makes sense.
Exactly. It's a good, healthy way just to keep tabs on the market and, by extension, your portfolio. Let's bring this back to the context of Australian expats and investing in shares. And I just want to make a note that for Australian expats listening, if you're looking at getting into some shares, building a diversified portfolio of shares, that you definitely can gain access to shares and build wealth through an Australian investment account, and do that as someone who's a non-resident Australian expat. And there's actually some fantastic benefits to doing that as well, particularly from a tax perspective. Now, generally for Adam, you and I, we're residents for tax purposes of Australia, which essentially means that all of our income, here in Australia, worldwide, subject to tax with the ATO, includes capital gains tax, which is essentially the tax on the increase in value. In the context of shares, it's the tax on the increase in value when we sell the share and we realize a capital gain. This tax doesn't apply if we're not selling the share. But so if you and I, if we're buying and selling shares, the increase in value is going to be subject to tax with the ATO. Now, what's quite unique for Australian expats, non-residents for tax purposes, is you can invest in shares and the increase in value is not subject to capital gains tax with the Australian tax offices. Australian tax office. So that's a really unique aspect of investing in shares as someone who's a non-resident Australian expat. Of course, you need to be mindful of any local tax jurisdictions, but in most cases, your overseas, local overseas, as in your international tax authority, it's probably going to be, in most cases, a little bit more friendlier than the ATO. I mean, Australia has some of the highest marginal tax rates from a global standard. So really great benefits there. And yeah, Adam, did you have any sort of further comments on investing in shares from a tax perspective for Australian expats?
Yeah, I mean, I think you've sort of touched on it pretty well there, Mitch. The big benefit is that non-capital gain scenario here in Australia. So yes, of course, in your local tax area, you'll need to take that into consideration, and different areas have different rules around that. And as you said, a lot of those can be a lot friendlier than particularly the way that non-resident tax rules in Australia work. They can be pretty heavy-handed when it comes to income generated here and stuff like that. So yeah, having that is one of the great benefits there in terms of yes, you got to deal with the tax situation back where your base is or where you're living. But yeah, it does I guess soften the blow a little bit compared to like yourself and I. We there's not a lot we can do to miss that. We've made the money. We've got to pay the tax. Yeah,
that's right. And I don't want to get too. I don't want to dive too deep into the technical side of the tax side of things. I think tax is something that's also very dependent on your own personal circumstances. So it's not one individual is not going to have the exact same tax outcome as someone else. So I think if you're getting into shares or ETFs or any sort of investment, understanding the tax nuances and the tax considerations for your own personal circumstances is critical to the success of your financial plan. 100%. Let's move into maybe just some really good tips and considerations for first-time investors. So if I'm someone who's looking to buy some shares or buy an ETF, for example, how would I go about that, Adam, in the best way?
Yeah, it's a really good question. So I think doing some market research or generally industry research of your own. Now, that sounds fairly daunting by saying industry research, but what we mean is just getting a general understanding from your own perspective, like what is a share, what is an exchange-traded fund, what is a market, what's a blue chip share, what's, getting an understanding for those sorts of terms and getting an understanding for volatility and things like that. And then from there, I guess what comes next from that is what are your goals? What are you trying to achieve? Is this a long-term investment? Are you trying to build the portfolio for wealth creation reasons, long-term? And what do you want from that? Is it a capital growth play? Are you looking at it, hey, we're holding to this for a long time, we're going to be adding to it periodically over time, and we're looking to build another source of wealth for the bigger picture? Are we doing this as hey, we've got a lump sum of money that we're trying to invest and we would like to create some passive income or some additional sources of income? Or is it a combination of the two? And the other point I just sort of touched on there, but to sort of dive back into is, if we're adding to the portfolio periodically over time, how much and how often? So, for example, if we're starting, say, with $10,000, but then we're putting $1,000 a month in, okay, that's very different to we're starting with $20,000, but probably putting in maybe a couple of $1,000s a year, depending on how the tax return goes, for example. So those sorts of things are really important, I guess, just to sit down and get a bit of a feel for yourself, to get some ideas, and or then reach out to a licensed advisor to have those conversations or assist you with that. But I think it helps to have some goals of your own, and doing your own homework from your own due diligence perspective before you have those conversations.
Yeah, just asking yourself, why are we getting into shares? What do we want to get out of investing in shares? Do we want to build wealth? Do we want to hedge against inflation? What are we looking to achieve in our own personal circumstances through investing? And that's ultimately what a financial advisor can help you with. And I think ultimately, even just having an initial conversation with a financial advisor, most of us, I know I don't charge, Adam, you may not charge for an initial consultation. Most of the time, we're happy just to have a chat with you, just to work through your situation and generally, give you some guidance in the first instance, just to kind of have you moving in the right direction. And then if it's a case where you know, seeking to get some advice, looking to build out a longer term investment strategy, then by all means, that's what we as financial advisors are here to support you with. And, you know, us as financial advisors, we've got a fiduciary duty to only advise if it's going to be in your best interest. It's going to leave you in a better position. If we can't add value, we're not going to recommend something to you.
Yeah, and I think it's something that I certainly throw around with new clients or new prospective clients with me is, as professionals, we have all these rules and regulations and compliances that we need to follow, and you know, we do our best to try and make sure our advice fits your goals and objectives and your best interests, you know, which is what we're here to do. But something I say to prospective clients for me is, at the end of the day, it's your money and your lifestyle. You need to be comfortable with what you're doing with it. So sitting blindly in front of a professional and just inherently trusting everything they say, it may not be the best move necessarily if something doesn't quite sit right with you. And it's either, at that point, ask more questions. I'm sure, Mitch, you're the same as me. You love clients asking questions of you, or prospective clients asking questions, because it means that they care and they want to understand more and they want to learn more. That's a good thing. Or if you're speaking with someone and they don't want you asking questions, or they're getting irritated with you asking, you know, simple initial questions to make sure you understand what's being proposed to you, maybe that's a little bit of a red flag. Not saying it is, but it could well be. So again, making sure that you're comfortable with whatever's being recommended to you. And if you're not comfortable with it, or you don't quite have the understanding, and they're not, and whoever it is you're speaking to is not willing to spend that time to help you start to build that understanding, maybe give it a second opinion. Yeah,
ultimately, you're looking to form a relationship with the client, right? Like we're looking to form a professional relationship with you. And at the end of the day, if you don't feel comfortable with that professional, then, you know, speak to someone else. I mean, it's many prospective clients do this, and they speak to multiple financial advisors, and ultimately, you know, it's just working with someone who you feel understands you and who you trust at the end of the day.
So it's the same as talking to a mortgage broker or talking to an accountant or a lawyer. You know, if you're in a situation where you need a lawyer for something, whether it's, you know, a commercial scenario or a family law matter, you know, you might speak to a couple of different people to get a feel for what their strategies are, or what their views are on the matter or on the topic, or what their specialisation is before you make the decision. Well, seeking financial advice or an investment advice is exactly the same.
Yeah, and it's not just the upfront advice that you get from an advisor. It's, you know, obviously the upfront initial advice is very important, but in most cases, a financial advisor can support you in an ongoing capacity on your investing journey. And I think in the context of investing in shares, you know, the term we use as financial advisors is investment behavior coaching. So essentially, you know, if we're investing in a portfolio, inevitably at some point, it's going to pull back. Markets are going to pull back at some point in time. It's not always going to be, you know, the share returns aren't always going to be positive year on year. So we are going to see some pullbacks from time to time. And I think that's one of the most undervalued or underrated kind of benefits of working with a financial advisor in an ongoing capacity. You know, if you're working with an advisor and you're feeling a little bit uncomfortable about what the markets are doing, you're not really sure if you should, you know, make some changes to your portfolio, an advisor can, you know, have a call with you, understand what you're feeling, and kind of just reassure you that the path you're on is the right one, and prevent you from making, I guess, emotional decisions when it comes to your investments, and, you know, potentially selling at the wrong time, selling at the bottom, getting back in at the top. We saw this a lot during COVID, during 2020. A lot of people going to cash, and then, as you said at the beginning of the call, the rebound was fast, right? Like, you know, it bottomed around March, and then come May, we were up 10-15%. And, you know, if you sold at the bottom, I dare say you didn't get back in before that went back up. So that's just one example. And I think it's just really, again, highlighting the value that an advisor can provide in an ongoing capacity as well on your investing journey.
Yeah, correct. And helping people understand or keep in mind, their overall risk portfolio and where the diversification sits. Now, something like a GFC or a COVID, which is what we call systemic, where you can diversify all you want, you're probably not going to escape the market pullback. But then that's where the timeline of investment and the bigger picture of what your goal is and what your plan is, it needs to be kept in mind. And that's where I guess the ongoing service and the ongoing support from people like ourselves is to keep that in mind for people. So during that period, like when markets pulled back quite rapidly and there were some wild, even intraday movements, which I've never seen before, and I certainly hope I never see again. I can't say that's going to happen, but with that sort of stuff, there was a lot of misinformation or unknown information and a lot of guesswork and educated guesswork going on from a lot of different sources. And some of those sources were highly reputable, but were very, very polarizing. They were very different to each other. And so if you're trying to time the market and do stuff like that, it was almost impossible. It's hard to do. It's almost impossible to do at the best of times. But in a scenario like that, it is almost gambling. Like you really don't know, and that's where it's important to keep that bigger picture in mind and those risk tolerances and what our overall goal is to avoid trying to make those mistakes where you're just buying and selling it on a whim based on something you've heard, read, or your mates told you. Which is really, is not based on, it's counterintuitive to what the big picture really is.
Yeah, absolutely. And, us as financial advisors in a market downturn, we don't sugarcoat it. It sucks. Like, if the portfolio is down, we can totally emphasize with you how you're feeling. This is your hard-earned money that you've put into the market. So we totally understand that. And, during those times of market volatility is usually when the media coverage, the financial news is at fever pitch, right? There's hysteria, every day there's headlines about, the ASX 200 down again. But all you have to do is zoom out and kind of look at the last 3, 4, 5 years time. Most investors are going to be up over the long term. You got to block out that short term news, because ultimately that's what sells headlines, and that's why it's
absolutely
there.
Yeah, it does. And the way that those headlines are written are very sensationalized. So instead of a 1 or a 1.5% drop in the market, say on the ASX, which we've had some of those in the last couple of weeks, mainstream media sort of news sites will talk about that in billions and trillions of dollars sort of valuation of what's been wiped off the stock market to make, because it gets clicks, it gets engagement, it creates uncertainty, fear, whatever you want to call it. But it looks scarier. But what they also don't talk about is in the days where the market's up 1%, or there's 5 days in a row where the market is up 3% in a 5-day period. I mean, these are not normal things per se. They do happen fairly frequently, I'd say. I'd label it. But yeah, you hear one side of the story in those sorts of news cycles, but you don't hear the other side. And certainly had conversations over the years with clients where it's like, oh, gee, seen on the market, that we've had a couple of days where we've been down a fair bit. It's like, yeah, we've been down 3% over the last X number of days, but over the last X number of months, the overall market's still up 5%. Like, we're still tracking pretty well for the year overall. So, but that doesn't get given the context, and I guess that's where people like you, yourself, and I come in to help guide.
Put things into perspective, right?
Yeah, exactly right.
Yeah, and it's probably a good segue just to kind of talk about the current market environment and what we see, shares doing over the next, say, 12 months. And I think, if we look back 2 years, I think the last market route, like downturn that we saw was through 2022.
Yep.
And, both shares and, your more defensive assets such as bonds both underperformed during 2022. So that was a very difficult year. But you could argue the last 2 years have definitely made up for that year and some. So we've had a really strong run the last 2 years. And I think what we're seeing at the moment is a little bit of froth coming out of the markets, a little bit of steam, a little bit of profit taking.
Yes.
There was a lot of market exuberance around Trump's election in November. And, the market reached a record high in February, mid-Feb. And then in recent weeks, I think investors are starting to pay attention to the to the implications of these tariffs that are getting imposed across the globe from the United States, and that's what's really led to part of the downturn that we've seen in only 3 weeks. I think I checked today, the ASX 200 is down 10%, and then the S&P 500 is down 10% over the last 3 weeks as well. But certainly, as I said before, you just got to take a step back, zoom out, look at what investments have done over the last 3-5 years, and it kind of, as I said, puts things into perspective. What are your thoughts on the current market environment, Adam?
Yeah, so it's interesting you say that. So off those market highs in February, and I tend to agree with you, the market was fairly frothy around Trump's election victory and a few other global sort of economic events, inflation starting to cool in a lot of areas and stuff like that. Still a little bit too high, in my opinion, in a number of key areas. I think we got a little bit of ahead of ourselves there, particularly on the back of the Trump election victory, that I don't think I saw any analysts anywhere sort of predict the market movement that we saw on the back of that. There's certainly plenty out there that thought it would be a positive to the market, but not to the degree it was. So I think some of the heat had to come out of that, and the chickens had to come home to roost at some point there. But that's not always a given. But to add context to that, though, when we talk about from that February market peak through to now, and that around 10% pullback that we've seen, but when you look at the 52-week performance of the ASX 200, so from this time last year, we're only down just under 3%. Mm-hmm. And then when you want to take into consideration in terms of that's capital valuation, but then when we take into consideration things like dividends and distributions and interest and other things that are earned over that time, what's the weighted average sort of look like there? So there's a number of factors that come into that, like you said, to add some perspective to it. Mm. And I think what we're seeing at the moment as well, with a lot of it's to do with the trade tariffs from the US that are being discussed or being thrown around, is what I've found over 13, 14 years of doing this is markets can react to good news and markets can react to bad news. And sometimes bad news can be good news. I've seen that plenty of times where you see market announcement and go, boy, this is not going to be great. And then the market reacts positively because the bigger picture looks more promising. What the market doesn't react well to is uncertainty. And that's not just in terms of markets and sectors or indexes, that's also individual companies. You have a company where a CEO suddenly passes away and the succession plan's not super clear. That creates uncertainty, and generally you see a lot of volatility short term in that share price. And same with markets, when we're seeing a lot of stuff being talked about in terms of tariffs and the percentage amount and what they're going to look like and who with and how and blah, 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 blah. It's all unknown, and the market's uncertain of what's it going to mean. Like the steel tariffs, for example, to Australia, to the US, should that go ahead and go into legislation, well, what does that mean for BHP and Rio and the iron ore players in Australia? We're not exactly sure yet. So that's why we see a lot of the sort of movements we're seeing at the moment, because it is all creating market uncertainty as opposed to very clear, here's what these tariffs look like, here's what this may mean for various countries or GDP, or what it's going to mean for individual companies, revenue and profit forecasts. Right now, we don't really know what that means yet. And so that does create a little bit of uncertainty, which then means we do see markets not moving probably quite as fluidly as we would normally expect.
Absolutely. And you hit the nail on the head there. Uncertainty is what investors do not like. Yep. And I think, that probably fueled the stock market rally that we had when Trump got elected.
Yes.
The election was very close, and in the lead up, it was very uncertain as to who was going to be elected. And I think just some certainty that, okay, it's going to be Trump. Yeah. And what are his policies? How do we digest this? That's really what the market was doing, and I think that helped with a lot of the market strength that we saw through that period as well.
Yeah, and the market was reflecting on, in Trump's first term, all the way up until basically March 2020, when COVID hit, his various policies and movements and things that he had put into place in the US, although some were very controversial at the time, what that did for the overall strength of the US economy and job market and stuff was really, really quite positive. So I think coming out of the uncertainty of the lead up to the election, I mean, we didn't even know whether it was going to be Biden or Harris running for at one point until, relatively close to when the election was on. So it created a fair bit of uncertainty. So coming out of that, we've got certainty, and then people sort of going, well, what do you think is going to happen? There was a fair bit of reminiscence on that period and in retrospect as well, when we can look back on 2020, we can see that what happened to the job market, the stock market, and a whole lot of other things in that final 8-9 months of Trump's tenure were factors that were completely out of his hand, and every other prime minister, president's hands around the world. It was a systemic factor that no one could control or had very little control over. So I think there was a fair element of that led to the probably getting a little bit ahead of ourselves in terms of that. And now we've seen Trump come in with the tariffs and the rules and the stuff he's coming up with. And I think that's sort of led to some trepidation of, this wasn't what we were assuming or hoping for.
Yeah, I couldn't agree more. And if we look at the outlook for the next 12 months, I think, we're going to see some subdued returns relative to what we've seen over the last 24 months. And there's a lot of, uncertainty in the market from a geopolitical standpoint, but there's also a lot of things that are working well in the economy. We've got inflation coming down, central banks have, been cutting interest rates, and there's a bit of stability around interest rates at the moment, which is good. And I think, contrasting right now versus maybe 2022 is, bonds are also acting as a nice defensive allocation in the portfolio. They're kind of doing what they historically should do in a market downturn. They're providing a bit of defense for a well-diversified portfolio. And there's absolutely still parts of the market that are doing well. Like if you look at Europe year to date, I had a chart up the other day, and I was looking at Europe, the Euro Stocks 50 index, which is 50 stocks in the Eurozone versus the S&P 500. I think the Euro Stocks 50 was up 12%, S&P 500 down 1%. So there's definitely, still parts of the market doing well. And if you've got a well-diversified portfolio, that is the whole purpose of having a diversified portfolio. You've got pockets of the portfolio doing well, and then parts of the portfolio, underperforming. You're never going to it's unlikely you have a period of time where everything in the portfolio is positive. It's used to give you a nice smooth return over the long term, right? We're not looking for, exorbitant returns every year, because if we're expecting that, we're gonna see some pretty sharp downturns as a result.
Yeah, and I think you're probably the same as me. At times like we're seeing at the moment, where we're seeing some pullback in the market, or some cooling in the market, or periods where we do see some downturn. What I tend to find is have a lot of existing clients contacting me about, is this a buying opportunity? And I think that's something as well for people.
I love those clients
who have cash on the sideline, or umming and ahhing about what to do, or whatever else, that where it's like, well, hey, maybe now is. I mean, I had a client the other day hit me up, had a fair bit of cash sitting in his self-managed super fund bank account. He had a few ideas about what he might do there, but then because markets had come off a little bit, he was like, do we put 50,000 into the self-managed super funds share portfolio and use this as a buying opportunity to add some exposure there? And it's like, yeah, if you're comfortable. We had a bit more detailed discussion than that about it, but then ultimately that was something they decided to do. That works for their specific circumstance, so it may not fit for everybody, but that's just an example of how sometimes these things present opportunity as opposed to being the end of the world.
Absolutely. Presenting opportunities is a key takeaway there. And I think just rounding out this discussion on the current market position is, pullbacks in the share market. They're healthy, they're normal, they're part of long-term investing. It's excess that needs to come out of the market before it sort of goes on its next run, so to speak. And long-term investors stay in the market. They're going to reap the rewards from taking that long-term view.
Absolutely. And when we talk to people about the investment timeline, we're usually pretty clear with people that these sorts of events are going to happen, whether it's now, next year, 5 years, whatever. We don't know. I say to clients, my crystal ball's about as good as yours.
Yeah.
But but the point being that these things can happen, and we try and factor those things in. And yes, there's going to be volatility, but at the end of the day, if we're not comfortable with any volatility, well, then we sit in cash. But then also we have to take the rewards that are there, which, until sort of 2022, when interest rates sort of rose significantly, particularly 2020 through to sort of 2022, when cash rates were at all-time lows globally, those cash returns were significantly underperforming real returns when you take into consideration the inflation effect that we were having at the time as well. So, yeah, there's those. That's why we have those conversations that, like we alluded to at the start of the conversation, about timelines of investment and what we're trying to achieve and things like that, and understanding people's risk tolerance. Because, I don't know about you, but in the years I've been doing this, I am yet to find something that will return me 18% per annum with zero risk.
Absolutely. Doesn't exist. Yeah. Sometimes you have clients that, want that. And then my response is usually, not sure. If you find it, let me know.
Yeah, exactly right.
No, that's probably a really good point to end on. And I really just want to thank you for taking the time out to jump in on the podcast. Thanks for taking the time, Adam. It's been really great to have you on. Some super interesting insights there. And thanks for coming on.
All right, thanks very much, Mitch. It's been great having a chat with you.
Thank you, mate. Appreciate it. Just on that note, this podcast is also on YouTube. If you want to watch the video recording of the podcast, you can find it there. And then I just wanted to make mention of our Facebook group that we've just started, Australian Expat Financial Insights. It's just a Facebook group where Australian expats can join and just share, ask questions about, any sort of financial matters when it comes to, managing your finances as an Australian expat. The objective there is just to build a bit of community, just to try and help each other. And then I'll be in there just trying to provide some general information, some guidance where I can as well. So thanks for tuning into the episode of Behind the Advice Australia, and we'll see you in the next episode. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.